So part three of the valuation basics is we're going to use the mathematics from a perpetual bond, from valuing a perpetual bond to value common stock. And this is the fun part. Eventually, what we're going to do is we're going to use that math to value Costco. But for now, what we want to do is develop our equations for valuing common stock. So as is the case with the previous sections, we're going to have a hypothetical problem, develop the mathematics, and then use the math to solve our problem. So our problem, our hypothetical problem is we are tasked with determining the common share price given the following parameters. Now these parameters are going to be different from the bond case, but there's going to be some similarities. Now, in the bond case, we have our principal balance. Basically, that's the face value of the bond. But in our case, for a common stock, what we want to do is we want to start with base operating assets. In order for a company like Costco to provide a service, they're going to need an investment in assets. And those assets are going to be buildings, stores, administrative offices, tables and chairs, desks, computer systems. There's going to be inventory. Everything, just look around Costco. It's not like they have bare shelves and you order online. I mean, there's a lot of inventory that's there and it's going to be in their warehouses. So all of that is dollar investment. So in order to generate a certain revenue base, you're going to need a certain dollar investment in assets. And what you'll find is the ratio of assets to revenue is basically constant over time given a certain industry. And then the share price, that's what we want to determine. The number of shares we're going to assume is 10,000. The annual dividend payments, we'll assume that that's one. So in other words, at the end of every year, the company will pay out the dividends. And what we assume for valuing common stock is we assume that the dividends start at net income. Net income is owned by the common stockholders. Basically, that's my revenue minus expenses, minus taxes, minus interest expense, and all that kind of stuff. Whatever's left over belongs to the common stockholders. And so that is where we start. But we can't assume that for every dollar of net income that gets distributed out to common shareholders because we have to have a balance sheet. If our balance sheet grows, if our base operating assets grow, then we have to fund that, and we fund that out of earnings. So the dividend payment is going to be net income minus the amount of that net income that I have to plow back into my operating assets, so in order to increase that balance to support a greater revenue base. So here we're going to assume that the return on assets is 12%, and you'll see where that factors in later. Our annual operating assets growth rate is 3.5%, just as in the case of the perpetual bond. The real rate of return is 2.25%, same thing. The inflation rate, 2.75%, same thing. Now, the risk premium is going to be different. With the case of bonds, you have default risk. But in the case of a common stock, you don't have default risk because with bonds, whatever you get paid is promised. I promise to pay you a certain coupon payment for so many periods, and then I promise to pay you face value. That's not the case with common stock. Common stock, you can think that, based on where I am right now, I can basically say that I think my dividend in year one is going to be X. My dividend in year two is going to be Y. But that's not a guarantee. It could be zero. I mean, they could go belly up. So therefore, we have to add a risk premium to compensate us for that volatility. And the risk premium can be looked at if I take the S&P 500 total return and subtract out the 10-year Treasury. We get a risk premium of around 4.75%. So what that says is if I want to invest in a risk-free asset with no default risk, I'm willing to pay the 10-year Treasury rate. But if I want to invest in a common stock, which is has an average risk. If I look at my total S&P 500 and I say, well, the average risk is X, then the risk premium that the market demands for investing in a risky asset, something like a common stock versus the 10-year Treasury is around 4.75%. So we're going to use 4.75% as our risk premium. So now we're going to take a look at some model parameter calculations. A lot of these are going to look very similar to the perpetual bond case, but there's going to be some differences. E1 is this is basically the value of common stock. Now this will be the value of all common stock, not on a per share basis, but just all shares outstanding. And like I said before, V subscript 0 would be the value of the after-tax net income, which is the start of the dividend, and then we have to subtract out the portion of that net income that I have to plow back into my company in order to grow my balance sheet, in order to grow my base operating assets. Equation E2 is operating assets, and we designate the letter capital A for assets, and assets are going to increase, they're going to increase over time. So what I want to do is make the assets time dependent. So I add a subscript T, and remember that T is time. So my assets at any point in time is going to be my assets now at time 0 times 1 plus G to the T power, and where G is the asset growth rate. Now E3 is the equation for my annual after-tax net income for our company. We're going to say that, and this is where the return on assets come in. We're going to say that net income for year T is going to be my operating assets at the beginning of time T times my after-tax return on assets, which is W. So therefore, I take equation E2, which are my operating assets, multiply that by W, which is my return on assets, and the product of those two is going to be my net income. This is the starting point for dividends. Then I have to calculate E4. This is our balance sheet investment. So in other words, if our revenue is growing by 10%, then my operating assets should also be growing by 10%. Because let's look at it in a case for Costco. If I grow my revenue 10%, chances are I'm opening other stores, which means I need more buildings, more inventory, more computer systems, et cetera, et cetera. So we're going to say that operating the balance sheet investment is X, and that's going to be time dependent. So I'd have X subscript T. And that's going to be operating assets at the beginning of time T times my asset growth rate, which is G. And that's going to be the dividends or the portion of net income that I have to plow back into my business. So the difference between net income which is NT and XT is going to be the amount that I can actually dividend to my stockholders. And that is the cash flow that we're going to value at the end of the day. And my market discount rate for our stock is small k, and that's going to be very similar to the bond case. It's going to be the real rate of return, same, inflation rate, same, but my risk premium is going to change. So rather than having something like a low 1.7% for my term bond or my perpetual bond, it's going to be higher than that because the inherent nature of common stock is they're more volatile and more risky than bonds. So I'm going to add 4.75% to my 2K. So if I add up all those three, then my market discount rate, this is what the market expects me to earn on this stock annually. Now that return is going to be both dividends, capital gains, and all that kind of stuff. But at the end of the day, I need to make 9.75% in order for me to invest in a common stock. Now this section is going to look very similar to our perpetual bond case. As a matter of fact, you can take the equations from the perpetual bond and change some of the lettering and come up with the equation above. E6, that's the value of my common equity. And remember that that's all common stock, not just on a per share basis, but everything. Really what that is, for example, in period 1, I take my net income in period 1 minus my investment that I have to make in period 1. Whatever the difference is that's what I can dividend out to my shareholders, and then I discount that at 1 plus K. The same thing for year 2. I take net income in year 2 minus my investment in year 2 and discount that at 1 plus k to the 2 power. And I go all the way to infinity. E7 takes equation E6. And again, this equation looks like a mirror image of what we already talked about in the perpetual debt case. But we're going to take E6 and we're going to add that summation. And then we're going to rewrite E6 and E7, and you can refer to the videos on perpetual debt, and you're basically going to see the same thing. And so we're using the equation for perpetual bond price, um, we can determine the value of common equity, and that's equation E8. So V subscript 0 equals. Remember in the perpetual bond case, I had the value of perpetual bond was R minus G, which is the coupon rate minus the growth rate, times B subscript 0, which was the principal balance of the bond. I changed that for common equity. The format of the equation is the same thing, except now I use W minus G. That's my return on assets minus my growth rate times my asset balance at time 0 times 1 over K minus G. And that's the value of all my common stock. Now, in order to get a per share value, what I want to do is I want to take that value of all common stock and I wanted to divide that by the number of shares. And we do that in equation 9 below. If we want to look at the discount factor over time, we can refer to the case of perpetual bond. Same thing is going on here. E10 is my discount factor, which just says in the case of the perpetual bond, it's 1 plus G over 1 plus K. And then the table on the left charts out the value of the dollar received in year 1 through year 10, or year 0 through year 10, and says what is that dollar worth cents per dollar. So in other words, if you look at year 10, if I expect to receive a dollar in year 10, then the value of that today, what I'm willing to pay for that dollar today, is about 56 cents. And the same thing if you look at the graph to the right, if we look at the discount factor over time, we start at a discount factor of 1 at time 0, and then it decreases over time. And because their risk premium is higher for equities than it is for bonds, then the market discount rate will be higher for common stock than it is for bonds. So therefore, your discount factor goes to 0 very quickly. And that's why we can look at common stock as a perpetual bond. You go back to the early 1900s, and you look at all the public companies, and then you look at 2026 and say, what are my public companies, or my big ones, and you compare the two, and a lot of those are gone. They don't exist anymore. So the question would be is why can we look at common stock as a perpetual bond when these companies, most of these companies won't even survive more than 100 years. Something will happen to them. Either they'll eventually go BK, or else they'll be swallowed up by another company. The fact is that they won't exist. So the reason why you can look at them as a perpetuity is because you can look at that graph, the discount factor over time. Because that discount factor goes to 0 so fast, what you're doing is you're weighting the early cash flows, and those later cash flows basically have 0 value. They have positive value, but they add very, very little to the valuation equation or the valuation result. So now we're at the point where we can answer our hypothetical problem. We were tasked with valuing the common equity, and we want to do it on a per share basis, given certain model parameters. Now the value of common stock is equation E8, and just like we did with the bond examples, is we want to split E8 into 2 parts. Notice that the E8 starts with W minus G, so we want to look at the W part separately from the G part. The W part of the equation is the value of net income, and that's W times my base assets at time 0 times 1 over K minus G. So if we look at the calculation there, W is my return on assets after tax. Multiply that by my asset base, with in this case 100,000, and then multiply that by 1 over K minus G, which is 192,000. So if the company took net income and just passed it through to the common shareholders, that stream of net income on a per share basis would be worth $192,000. But that's not going to be the case, because in order to get a stream of income that grows, we're going to have to invest in our balance sheet. If our revenues grow such that net income grows, then the balance sheet will grow too. So part of the earnings from the company, net income wise, will have to be plowed back into the company. So that's what we're doing in 11B. We're taking the G part of that equation, which is we can take 11A and just substitute G in for W. And what we're going to come out with is the value of the balance sheet investment is 56,000. So what that says is 11C. It says the value of common equity equals the value of net income minus the value of the balance sheet investment. So that's 192,000 minus 56,000, or 136,000. That 136,000 is the value of common equity. And so what I do is, in order to get it on a per share basis, I take the total value of common stock, which is $136,000, and I divide it by 10,000 shares. So my per share value today is $13.60.